Welcome back to Scaleup Stories, Season 1, The Acceleration. So far, we've covered the fundamentals, the leap from 0 to 1, the power of building a data moat, and how to design a decentralized team that doesn't collapse into bureaucracy. Today, we're moving into the part of scaling that quietly decides whether you survive the next level or not, financial architecture. Because here's the trap. A lot of founders hit momentum and assume the equation is simple. If I want 10 times the outcome, I need 10 times the spend. More headcount, more overhead, bigger offices, larger ad budgets, bigger everything. And that's exactly how scale-ups with real revenue still fail. In 2026, it's often not revenue that kills the company. It's capital volatility. The money shows up, but the structure can't handle shocks, lockups, currency risk, tax friction, or simple operational leakage. So the goal today is not make more money. It's build a system where capital can expand without exposing your entire business to a single point of failure. Think of it as moving from a basic bank account mindset to an asset-based, globally distributed architecture. Less fragility, more sovereignty. Let's get into it. First, the shift, startup finance versus scale-up finance. In a startup phase, money is mostly about survival. You're extending runway, protecting cash, keeping things simple. Your reserves tend to sit in local banks. Costs rise pretty linearly with headcount, and you're usually operating inside one main jurisdiction and currency. In the scale-up phase, that approach becomes dangerous. As you grow, centralized exposure expands faster than you think. One banking disruption, one currency devaluation, one compliance event, one payment processor issue, and suddenly you're not scaling, you're stuck. So scale-up finance becomes about multiplying assets efficiently, diversifying across currencies and jurisdictions, and investing in systems that scale without needing an ever-growing payroll. In other words, you stop storing surplus in vulnerable places and you start building anti-fragile infrastructure. Now I want to walk you through what I call the laws of high-leverage financial scaling. These are principles, protocols, really, that aim for a specific outcome. Your capital grows geometrically while your exposure stays low. Law 1 is capital recycling. Instead of pulling short-term profits out to buy things that lose value, you push surplus back into assets that compound. Intellectual property, proprietary workflows, unique data, internal automation, and infrastructure that keeps producing without constant human effort. Law 2 is the multi-currency node network. Don't let your entire operating base be hostage to one currency and one economy. Spread operating capital across multiple currencies and jurisdictions. When one node gets hit by inflation, policy changes, or local downturn, the others stabilize the system. Law 3 is zero-based administrative cost. This one is uncomfortable, but it's essential. Any recurring expense that doesn't strengthen retention, improve your moat, or measurably increase output is suspect. If a tool can be replaced by an internal automated workflow, you move that money into building your internal capabilities instead of renting them forever. Law 4 is a cold reserve treasury. A fixed percentage of your liquid capital should be stored in a highly secure reserve that's insulated from everyday operational risks. The idea is simple. Your foundational reserves should not be sitting where a single centralized failure can freeze them. Your business needs the ability to keep operating even during systemic stress. Law 5 is autonomous revenue recognition. The faster you can move from delivering value to realizing clean liquidity, the healthier your system becomes. Build payment, clearing, and settlement flows that route revenue directly into designated reserves and operating pools without creating a maze of manual handoffs. Law 6 is the AI audit protocol. Don't wait for a yearly review to discover leakage, misclassification, or tax anomalies. Use automation to review transaction activity continuously. Daily visibility changes behavior. It also catches small problems before they become existential ones. Law 7 is treating intellectual property like a balance sheet anchor. In the scale-up phase, the biggest assets often aren't physical. It's your brand, your unique operating methods, your internal libraries, your training data, your prompt systems, your proprietary content. Those assets need to be tracked, protected, and valued like the core of the enterprise because that's what they are. Law 8 is separating asset ownership from founder liability. As the company grows, the risk landscape changes. The point here is to avoid a structure where a single legal event pulls founders and core assets into a vulnerable position. You want a robust setup where critical assets are shielded and governed by clear rules, not informal assumptions. Law 9 is marketing arbitrage through trust, not noise. Instead of burning capital on blind reach, you invest in partnerships, deep collaborations, and reputation assets that pull in the top tier of your market. When your positioning is strong, you stop competing on volume and start competing on credibility. Law 10 is the unit economic firewall. Every action at scale should be defensible in unit economics. If a funnel, workflow, or department costs more than the value it creates, it is not a temporary phase. It's a leak, and leaks at scale become floods. Law 11 is the phantom headcount model. Real scaling doesn't mean endlessly hiring. It means extending output through software and high-performance automation. Your financial signature changes. Higher investment in technology, flatter growth, and payroll. That doesn't mean no team. It means a deliberately designed team supported by systems, not replaced by chaos. Law 12 is long-termism arbitrage. If you only plan in 30-day windows, you'll keep making fear-based decisions. Scale requires a 5 to 10-year thinking. That time horizon gives you the confidence to invest in real moats, deep tech, brand equity, and infrastructure, without panicking when short-term conditions fluctuate. Law 13 is an emergency protocol. Your system needs a defensive posture for worst-case scenarios. Hostile events, systemic financial disruptions, platform lockouts. The exact mechanics will vary, but the principle is consistent. You design a shutdown and protect pathway so the enterprise can preserve its core assets if something truly abnormal happens. Law 14 is the value-add subsidy. If you're in services, racing to the bottom is a slow death. Instead, raise the standard, raise the price, and use automation and proprietary insights to deliver dramatically more value. Your moat is what makes premium pricing sustainable. Law 15 is asynchronous payroll. Particularly with remote specialists, you get better performance when you pay for outcomes and quality, not for hours and presence. Tie compensation to deliverables and metrics. Reward efficiency. Remove the incentive to look busy. Law 16 is jurisdictional optimization. This isn't about games, it's about structure. Digital businesses get trapped when they operate as if geography is destiny. Use appropriate entities and jurisdictions that fit your model, protect your assets, and reduce unnecessary friction while staying compliant. The scale-up advantage is flexibility, but only if you design for it. And Law 17 is the infinity loop. Money is an information signal. It reflects value delivered. When you build systems that increase value throughput, reduce friction, and protect the signal from distortion, the financial results follow. Manage the system, and the numbers obey. Now, how does this look operationally? Imagine your financial funnel is automated end-to-end. A customer converts, payment clears, revenue is categorized instantly, allocations happen automatically into operating budgets, reserves, infrastructure reinvestment, and experimentation funds. In that model, you're not acting like a cashier. You're acting like an architect. You review dashboards, adjust levers, and improve the machine. This leads directly into a common failure pattern: premature scaling. Revenue jumps, and suddenly founders lock in fixed costs. Overhiring, long leases, sprawling tool stacks, assuming growth will forgive the waste. It usually doesn't. Watch for 3 flashing warning signs. 1. Your customer acquisition cost is rising faster than lifetime value. If it costs more to bring customers in than they'll ever generate, scaling just accelerates the damage. 2. You're using next month's revenue to patch this month's inefficiencies. That's a debt cycle disguised as growth. Fix the system first. Don't fund your mistakes with future sales. 3. Your systems aren't modular. If one broken tool can freeze accounting, payroll, or revenue tracking, you don't have architecture. You have a complicated pile. Scale demands modularity and redundancy. So let's talk about a modular treasury blueprint. How to allocate surplus in a way that builds durability. One model looks like this. About half of surplus goes back into infrastructure, AI development, computing, R&D, and strengthening the moat. Around a fifth goes into a hardened reserve, truly defensive capital designed to survive shocks. Another fifth supports a specialized node team. High-skill operators, analysts, and contractors who expand output without bloating the org. And the remaining slice becomes an innovation fund, small experiments that may become the next growth engine. To run this well, you need the right dashboard, not a messy spreadsheet with endless manual entries. A live system that shows a few truth metrics. First, capital velocity, how quickly spend turns into return. Second, a reputation index, organic trust signals, high-quality mentions, inbound from serious buyers. Third, operational friction, how many human hours it takes to fix a process or communicate change. If friction is rising, your architecture is breaking down. And that brings us to the role of the financial officer in a scale-up. At this level, finance is not primarily bookkeeping. It's strategy. It's risk management across currencies, geopolitics, and supply chains. It's data-driven allocation, deciding which node needs investment, which workflow needs automation, which product line is quietly bleeding margin. And it's asset protection, especially your IP and your reserves. We also have to address the environment. Inflation and volatility. If you rely purely on cash, you're often losing purchasing power by default. So protection becomes a blend of resilient assets, diversified reserves, and continuous value creation. The businesses that survive volatility are the ones whose offerings stay essential, even when budgets tighten. Strategic reinvestment in R&D is part of that. Scaling isn't maintaining. It's staying ahead. Invest into new technologies, better simulations, stronger workflows, tighter systems, and the development of your key people, your nodes. Because the future doesn't reward the company that got big once. It rewards the company that keeps upgrading its engine. And none of this works without cognitive wealth management. When the numbers get bigger, emotions get louder. Discipline matters. You need steadiness under volatility, frugal operations, even when revenue is strong, and focus on compounding over quick wins. The scale-up game is largely psychological. Can you keep making clean decisions when the environment is noisy? Your personal role evolves too. You move from operator to architect. Your job becomes setting vision, designing systems, and aligning the tribe. You're not supposed to be buried in approvals and transactions. You're supposed to be improving the machine that produces outcomes. Because ultimately, compounding value is the point. Content assets keep producing after they're published. Data assets get smarter with every interaction. Reputation capital builds trust that makes future growth cheaper and faster. That's real scaling. Assets that keep working while you sleep. To protect those compounding assets, legal structure matters. Many scale-ups benefit from modular setups. A holding entity for core IP and brand, operating entities per region, and protective structures for long-term resilience. The exact configuration depends on your context, but the principle is consistent. Designed for protection and flexibility, not convenience. And always keep the global perspective. In 2026, you're rarely competing in a purely local market. Build borderless operations where possible. Respect cultural differences in messaging, and maintain a network of global peers, because opportunities, warnings, and partnerships now move internationally by default. Looking forward, financial scaling becomes even more automated and decentralized. Smart contracts and automated agreements reduce friction. AI advisors assist with allocation decisions in real time. Digital currencies and modern settlement rails make international operations faster. The winners will be the companies that design for that future early, instead of scrambling to retrofit later. If you want proof this works, look at the patterns among leaders across industries. Tech giants protect their edge through R&D and data infrastructure. Content platforms stretch one asset into many revenue streams across the world. Service integrators improve margins through automation rather than endless hiring. Different businesses, same principle. Architecture beats hustle. So here's the takeaway. Financial architecture isn't just accounting. It's not just being good with money. It's building a system that compounds value while defending your downside. When you detach from cash dependency and start thinking in resilient assets, automated flows, diversified nodes, and modular protection, you stop being a participant in volatility. You become the designer of stability. Next episode, we'll talk about the scale-up exit, how to pivot, transition, or expand into new dimensions without giving up market share or losing control of what you built. This is Scale-Up Stories.